Welcome, everybody, to our session today. Thank you for joining us for today's webinar, Q3 and Q4 Emergency Update Post-IRS R&D Guidance. This session is designed to provide you with the latest legislative and procedural developments impacting IRC Section 41, which is the R&D credit. And this installment will focus on the transition from 174 to 174A, new documentation requirements to the Form 6765, key elections that are clarified under Proc 2025-28, as well as audit trends and court cases. This session also qualifies for 1 hour of CPE. My name is Vivian Kors, and I'm a partner at Cherry Becker. I'll be one of your speakers today. I'm also joined by Brian Morris, who's a senior manager in our tax credits and incentives group. So we look forward to diving in. So as we kind of briefly chatted about, we'll be going through kind of the latest OB3 updates for R&D as it relates to 174. We're going to also give you a quick update on the Form 6765 disclosures. In addition, we'll touch on some state credit updates. There are some certain changes for different states, as well as covering certain audit trends and court cases that we've seen in the market. So the Tax Credits and Incentives Advisory Group, we compose of more than 50 professionals with extensive experience in all things R&D credit, cost segregation, energy credits, 179D, as well as state and local tax incentives. So to the extent that you guys are conducting R&D activities, or maybe you're purchasing or refurbishing commercial real estate, investing in alternative energies, or you're looking to expand into different areas, or maybe looking for new jobs, looking to lower your tax liability, those are all things that we could help with, and we would be happy to consult with you. Polling question number 1, so that we can get our CPE in. How did you hear about us? Is it through a Cherry Becker tax advisor? Is it through an email from Cherry Becker? Maybe friends and family? And then maybe from a Cherry Becker alumni or a social media post. And I don't think we will keep this on for too long. But Brian, how do you generally hear about, I guess, like webinars?
I get an email forwarded to me and said, hey, you should absolutely join this. But, every once in a while I'll get a text, an email from someone I used to work with. And, again, all great insights getting view from all sides.
So I would say most of this is from emails from Cherry Becker, and then as well as emails from your Cherry Becker tax advisor. So we appreciate all of those in the marketing team who helped us prepare this and get this out. With that said, if my mouse cooperates with the OB3 updates for R&D, Brian, I will turn it over to you.
Yeah, absolutely. Thanks, Vivian. And I very much like OB3. That rolls off the tongue a lot better than OBBBA. So as folks on the line may know, the One Big Beautiful Bill Act passed on July 4th this year. But even before we get to those updates, there's a lot on this screen right now, but just a very brief summary or history of this is that, if we go back in time to the Tax Cuts and Jobs Act, which passed in 2017, there were a few budget balancers built into the legislation that kicked in starting for tax year 2022. A big piece of that was Section 174, or mandatory capitalization of research and experimentation expenditures. That's a mouthful. And the story here is that there was bipartisan support to repeal or delay this, both in the House, the Senate. But as the years went on, the results just weren't coming through until we flash forward to 2025. So if we go to the next slide, maybe even before then, right? We're talking about 174. What was this rule? What are the costs that are in play? So the long and short of it was, starting for tax years 2022 going forward, there was a requirement to capitalize research and experimentation costs if they were occurring domestically. So resources were physically in the US, they would have to be capitalized and amortized over a 5-year period. And if you had offshore resources, whether they were employees or offshore contractors that you engaged, those would actually have to be capitalized and amortized over a 15-year period. So a fairly substantial hit to a lot of taxpayers focused on development. And whenever we're talking about specified R&E costs or expenditures, really, this is all cost incident to development. So there's an analogy with the marble and the bowling ball. So the marble is your R&D Section 41 costs. So wages, supplies, contractor costs, cloud costs, and then you expand your window or the bowling ball to all costs incident to development. So if you have an engineer that's physically going into an office, there's a portion of overhead allocated for that individual, rent, utilities, depreciation on their laptop that they're using, software licenses. So again, this is a very expansive definition of what needed to be capitalized. And it was a burden for taxpayers to go through, and rather than deduct these timely, to go through and capitalize them over a longer period of time. Now, going into 2025, if we go to the next slide, there were some very taxpayer favorable results that came through. The biggest one being that for domestic R&E costs, so that keyword here is domestic, for tax years beginning after December 31st, 2024, there was no longer a requirement to capitalize. So taxpayers can go back and expense those. That said, there were a few avenues to recoup 22 through 2024 costs, so be able to deduct those sooner rather than later. We'll go to the options here in a bit. But again, the big news here was that, hey, looking forward, domestic costs no longer need to be capitalized. Foreign costs are still subject to the previous capitalization regime. So if your companies are still incurring offshore costs, you're engaging those nearshore contractors or offshore contractors, you have an offsite facility in rest of world, those costs still need to be analyzed and capitalized over a 15-year period going forward. So I think here, moving on to the next slide.
And I was just gonna say,
Yeah.
on the foreign R&E costs, some of the things that I feel like people don't think about is, hey, all of my vendors are, in the US. Every firm that I'm paying is all in the US. I don't have any foreign R&D. That's not necessarily true, because it's, again, where the resources are located. So a lot of times you could be paying a physical address in the US for maybe software development resources. And a lot of times that company will hire software developers who are both maybe onshore and offshore. So a lot of times it would be working with your vendors to figure out, okay, how much of the costs associated with this endeavor is for onshore resources versus offshore resources. And a lot of times just dividing it by headcount is not the most accurate or favorable way, because the offshore resources could potentially cost less. So a lot of times what we see is maybe the PM sits in the US and then they have like 10 offshore resources that they work with who sit in India. So this vendor cost, for example, $10,000 wouldn't necessarily be 1,000 in the US and then like 9,000 offshore. It would probably look more like a half and half split. Another thing to think about is if you have maybe foreign trials and you're paying a US vendor to maybe make some prototype drugs for you that is used in the trial, and the trials are both onshore and offshore. Usually we find maybe patient count would be the easiest way to kind of divide the costs up for what should be allocated onshore versus offshore. The flip side could be true too. So if you hire an offshore vendor to make your prototypes or to help you manufacture drugs for clinical trial purposes, and all of the clinical trials are in the US, that would be onshore R&D that you can expense, even though you're paying an offshore vendor, because those drug costs, they're consumed in the US, and the R&D and the clinical trials are happening in the US. So again, it's very dependent on your facts and circumstances, and definitely something we can help figure out so that we can establish a proper method going forward.
Oh, that's an excellent point, Vivian. I think we jumped a slide.
Oh, sorry.
So just to piggyback off that comment too, again, we see this more in the world of software development. So even if the majority of your team is physically in the US, it might not be as simple as saying, hey, we know this is an offshore vendor, it's X% of their costs. Let's say that you're shouldering the cost for software licenses that offshore team is using, or you're leveraging a cloud instance. So Azure, hopefully everyone here didn't feel the pain from the AWS outage the other day. But if you have a cloud instance that offshore contractors are also leveraging, you'd also want to contemplate, hey, do we need to allocate a portion of those costs to offshore resources, leveraging something that might be billed to the US entity? But excellent points. So, what we're looking at now, right? We have choices. We have options for domestic R&E costs incurred prior to 2025 and how we can treat those on a go-forward basis. On the next slide that Vivian, briefly showed, I'm very visual. I think it's very helpful to see everything laid out. But just to talk through some of these points here, right? There is a few different paths that can be taken. Obviously is, hey, no change for prior years. So if the company did go through and capitalize domestic R&E for 2022 through 2024, the first path, maybe the most obvious, just let that amortization run out. That might not be the most favorable for your situation, and everyone's facts and circumstances vary, right? So we want to make sure that as you're going through and looking towards 2025 and future tax year planning, you're weighing your facts and circumstances, what options we have here to expense the remaining amortization basis for domestic 174. So again, first option, we just let that run out over the remaining period. The next is that, all remaining amounts or amortization basis from 22 through 2024 can be deducted in 2025. Alternatively, that can be deducted ratably over 2 years. So 50% of the costs for 2025, 50% in 2026. Again, we want to think about what tax years the company may have. How does that change the approach and facts and circumstances? And then the last piece that we still have an available option for calendar year taxpayers is going to be including an election statement going back to amend prior years. Again, this could introduce complications if we have to go back and amend 22, 23, 2024. What is the impact to states? Does that create additional burden to go through and amend not just federal, but states, those that are coupled with 174? So again, a lot of different things to consider here. I mean, Vivian, what are some of your considerations or maybe some stories that you've run into as, we got guidance at the end of August, right? Tax returns due 9/15, 10/15. Any situations that you want to share with the group here?
Yeah, I definitely I have so many. That was all of my September and October, basically. But there are definitely a lot of things to contemplate. It's not as straightforward like, oh, I want money back, let's do this. Some of the things to think about is you'll be getting a reduced credit when you go back and amend. So there's this rule, what's going to be called 280C. Basically, the government doesn't want you to get a benefit from the R&D tax credit and then also get a deduction for that same expense that you're getting the credit for. So they said, instead of taking 100% of the credit, you can make a 280C election, which essentially is a net effect of your gross credit to bring it down by 21%. So the tax rate, the corporate tax rate. So instead of, if you're entitled to $100,000 credit, you get $79,000. The alternative way is, hey, I don't want to make that 280C election. I'm going to add my gross credit back to my taxable income so that I'm not double dipping on the expenses. And then basically you kind of get to the same answer. It's just administratively much easier to take the 280C election. 280C election would come back into play. So during 22, 23, and 24, if you amend and you deduct your expenses, you're not going to get 100% of that gross credit. You're going to get a reduced credit for that. That is something to think about. Also, just like logistically with the IRS backlog, we're seeing refund claims take up to a year to be processed. So having to chase that down. There's also that CCM disclosure requirement that potentially should not be triggered, but might get triggered just maybe due to the processing of how the IRS runs these. So the CCM, just very briefly, is there's additional disclosure requirements that you would need to file with your amended returns if you're requesting for a refund as it relates to the R&D credit claim. When you make an amendment to deduct your domestic claim, it doesn't necessarily fall into that category of I am getting a refund claim for claiming R&D. But the IRS might not be able to distinguish that when they run their data scans, and they might just say, hey, you didn't send in your additional disclosures, this is denied. That might be an issue in addition to processing time. And then some other interesting things to think about would be, who are the owners during that time period? Maybe you went through a transaction, right? So did the transaction price already contemplate the deferred tax asset of Section 174? Should you go back and amend? Who's going to benefit from you amending? So those are all things to kind of think about whether or not it makes sense to go back. And then tax rate differences. So did you make an entity change or that resulted in a tax rate change? Those are all things to kind of think about whether or not it makes sense to go back and amend. Brian, what about you? You have any other interesting ones? Did I steal it all?
No, I mean, there's a myriad of different factors to consider. I think some of the more unique situations that I came across this past busy season, one was for a startup software company that, hey, they were just starting out, first couple of years in existence, but through their startup, they were not a trader business, right? Operating as a trader business. So they were capitalizing everything under Section 195. So the drive, not just to get into compliance, was to identify Section 174 costs. So the team could start capitalizing and amortizing those over a 5-year period rather than the 15-year period and waiting for 195 to take place. So again, just in this back and forth, hopefully everyone's seeing that, hey, there are a ton of different factors to consider. Everyone is truly unique. So again, we're in October right now. We're still in 2024. We just want to make sure everyone's thinking about, hey, how does the ability to expense R&E costs affect us going forward? And if you're not already talking to your tax service provider or specialist, please make sure you're reaching out. Feel free to reach out to us. This is, like Vivian said, right? This was September, October, what we were primarily focused on. So we're absolutely here to help and be your guide forward.
And I forgot to mention, one of the other things to contemplate when you're deciding, should I deduct it over 1 year or 2 years or continue for no change, is around 163J business interest expense limitations. So business interest expense limitation is calculated starting in 2025 based off of EBITDA. And we have clarification from Rev Proc 2025-28 because they keep referring to this write-off of your 2022, 2023, and 24 174 amounts as unamortized amortization. So it's like becoming even more clear that it should be considered part of that EBITDA's So it will be considered amortization. So when you are determining your 163J business interest limitation, that hopefully will bump you up a little bit more because your EBITDA is going to be huge.
So really quick, Vivian, before we get to the polling question, someone dropped a question in the chat. Okay. Must all offshore R&D investments be capitalized, such as bug fixes, enhancements, or is it only required for development of new products? The latter is my understanding, with amortization beginning with rollout.
That is correct. So the bug fixes, maintenance, keep the lights on, all of those costs aren't considered software development. And if you wanted to dive a little deeper, you can either watch some of our webinars that talk specifically more around 2023-63, because that RevProc gave very clear, or not very clear, it does give guidance as to what is considered software development and what falls out of it. So if your bug fixes are minor enough that it didn't enhance the overall product or improve your platform, then that bug fix doesn't qualify for 174. So you don't need to capitalize and amortize that. But thank you, Brian. So we have polling question number 2. Make sure you answer this so you get all of your CPE. The question is, are you an eligible small business looking to retroactively deduct your previously capitalized 174 costs? We did not talk about the definition of this. Right, Brian? I don't think we did. So whether or not you're an eligible small business really is on what your prior 3-year gross receipts look like. So your average prior gross receipts need to be less than 31 million. So if you're right on the cusp of that, let us know. We'd be happy to kind of do an analysis to make sure that you are or you are not a qualified or eligible small business. But I would say, and again, short tax years also count. So if somehow in there you have a short tax year, you would have to annualize that and look at it from what the average annual gross receipts would look like. So most of you guys are not an eligible small business looking to retroactively deduct. And I would say that's very much on par with what we've seen. A lot of times it doesn't make sense to go back and amend your tax returns for the myriad of reasons that we kind of just mentioned before. Jump to the next slide. Okay, so the Form 6765 reporting requirement changes.
All right. So, maybe folks are aware of this, but over the last, year and a half, there's been a lot of buzz and newly released Form 6765. So this is the federal R&D credit form in which your R&D credits are reported on. Previously, it was a two-pager, entirely quantitatively driven. So reporting what your research expenses are, what kind of credit methodology you're going with, and then that was the extent of what would be included on the federal return in order to claim the credit. And to pick up on what Vivian mentioned earlier about the Chief Counsel memorandum that came out in October of 2021, where for taxpayers that are going back to make refund claims, there's additional information required that taxpayers have to provide in order to be compliant for the refund claim. So what type of information the taxpayer was looking to discover, types of business components, qualified research expenses. So again, in line with what we saw back in 2021, as well as how the IRS is examining research credit calculations, we're now seeing additional requirements in the form of disclosures that are coming in on the new Form 6765. So again, for the first few points, this is just the timeline, right? That there were updates that were released back in June of 2024. The updated form was released December 12th, and then we got IR 2024-313, which summarized the draft Form 6765 as well as the instructions. So there's a bit of a timeline of a bit of a history here. But the big takeaways were that the form changed. There's additional information that needs to be included on the federal return filing. And up until the end of September, all parts of the form were going to be required for tax years 2025. We did get an update on October 1st of this year that there is a delay on requiring all elements of the form be filled out until tax years beginning after December 31st, 2025. So a bit of relief there. But that said, we want to make sure that taxpayers are thinking about their R&D tax credit study process. Is there rigor around it to where that information could be filled in relatively straightforward, easily? So, here at Cherry Becker, whenever we do an R&D study, we're shaping the process, the format, the procedures such that we're collecting this information, we're rolling this out even for 2024 R&D tax credits. We want to make sure that we would be in a great position to start filling in that Section G. And yep, Vivian jumped ahead. So there's a lot going on this screen here, right? Really, it's a plethora of new information that needs to be included. Again, now for 2025, this is all still optional, but there's a lot of information that does need to be included. In fact, I have to get really close to the screen so I can see this a bit better, right? So it's laying out, if you're in a controlled group, right? So if there's common control amongst multiple entities that are doing qualified research and development activities, it's listing out business component, right? So a product, process, a formula, invention, piece of software, or a technique by entity, listing out the business component name as well as the type, right? So there is a set definition of, hey, we are generating wage research expenses. We have contractors. We're using cloud compute. So it's not just a matter of going through and computing, hey, what are my qualifying research expenses in order to compute the credit? It's going through and making sure there's qualitative information to say, hey, how do my research expenses actually roll up to our business components? Moreover, if there's, software, there's different kinds of software. There's internal use software. There's dual purpose software. There's externally facing software. So again, on the left-hand side of the screen, we're getting a glimpse at some of the required information that will be needed down the line, but absolutely start thinking about this if you haven't already in terms of what's going to be going into this. Moreover, if we go to the right-hand side of the screen,
Oh.
Section G continues. So not only is it breaking down, hey, our buckets of qualified research expenses, my wage QRE, that's generally a driver of someone's R&D credit. So it's understanding, hey, what are my research expenses by my defined business components? So one of those 6 options. Moreover, breaking this down, and this is going back to that CCM and what we're seeing during reviews by the services, breaking down qualified wage research expenses into direct supervision, direct support, direct performance of R&D. So again, there's a lot that needs to go on here. And Vivian, keep me honest here, because some taxpayers, right, that you could have more than 50 business components. The requirement here is to list out the top 50 or representing 80% or more of your qualifying research expenses. Is that right?
So the less of, yeah.
Less of. Okay.
Lesser of, sorry.
Perfect.
And I think this is so important. And this is one of the key things that I always say why our studies are done certain ways is because we need to establish that nexus between the qualifying activities down to the qualifying dollars. So your qualifying activities are by business component. We need to make sure that we get your qualifying research expenses by those business components. So it's not just aggregating everything and saying, oh, 80% of my people do R&D. I know that. I'm going to put 80%. It's 80% of your people do R&D, but how much of each person is doing R&D on which project? And I think that's the important documentation that the IRS is looking for if they do come knocking on your door. And I think it's important to talk about who is also, I guess, who for Section G does it continue to be optional. So if you're a qualified small business that are using the R&D income tax credits to offset your payroll tax, there's an election that you make. So for those types of taxpayers, Section G is optional. And also Section G is optional for taxpayers whose QRE are less than 1.5 million for that year, and their gross receipts are less than 50 million. So just kind of keep note, like, hey, my QREs are right on the cusp of that 1.5 million. It's better to get that process set up because your R&D is likely going to grow, and make sure that your process can grow with you to support you. There's also, I think, other interesting parts of this Form 6765 that's new that I feel like, although Section G is not required, it's important to get your business components right. The number of business components is now a requirement for you to report on. And again, there's that year-over-year consistency requirement of your R&D credit. So it would be a little suspicious if you have one business component 1 year, and then all of a sudden when Section G is required, you have 20 business components or 80 business components. So it's important to get it right and know what type of business components you are thinking about reporting. I think the officer wages one is interesting, Brian. For me,
Yep.
I think we work with some small businesses that are very flat. Maybe not even small businesses, but generally flat organizations where the CTO is so hands-on because he's the one who built that platform from scratch earlier on, and he's still very involved in R&D. And he could be an officer, or maybe even the CEO, right? For some of the smaller startups, they require officers qualifying research expenses to be specifically called out on line 38. And I think that's maybe their way to see how much upper level management R&D QREs are you claiming. And if we get into some of the bigger companies who have millions in maybe because they exercise stock options, that's going to be so interesting.
Yep. And, with that, right, for companies, like you said, Vivian, that are just starting out smaller, everyone's wearing a lot of different hats. It's not beyond the pale to see a CTO, a CEO, a COO that's involved in development. But to your point, right, the IRS always has on their radar, are there any whales? Do we have someone who's making $10 million or more that is substantially all involved in development activities? So again, just as part of the updated 6765, again, we're seeing this parallels some of the items that are coming up during IRS audits where they're looking into high wage individuals, officers that are being involved. So again, this is fairly straightforward to go through and identify any officers for the company, what their wage QRE is that is being included on the 6765, but a good review point, right? And something that as we're looking at any R&D studies, we want to make sure that there is sufficient documentation. And that's actually going to come up later on in the presentation on some recent court cases. So is there contemporaneous technical documentation that can tie an officer, high wage individuals back to development? Is there that paper trail or those cookie crumbs? Before I forget, I did see there was a question. Will Cherry Beckert be providing an input form to assist with completing the 6765? And I think the answer here is yes. So as part of our studies, right, not only in our deliverables are we providing the overview of current credit law, the methodology memorandum, and our work papers, as we're going through and preparing numbers so that they can be included on the return, we do provide a pro forma 6765, even if you're not engaged with one of our tax teams to prepare your return. And we'll obviously coordinate with any outside parties too. So your tax return preparer to ensure that there's no questions back and forth. Because again, we want to get to the right answer cohesively and make sure that, as the new form is being rolled out, everyone's being compliant with it. So hopefully that addressed your question. Just looking at the list, right? And there's, again, a lot going on this form, not to touch on every single difference here, but Vivian picked up on officer wages. I believe that's down in Section E. So this does look similar to the older version of the 6765. I think the big changes for Sections A and B is that rather than listing out your qualifying research expenses, that's now at the bottom in Section F. So just, again, similar information just rolled out a different way. Section C, no significant changes. Section D, minor update for qualified small businesses making the business payroll tax election. Again, that's stemming back from the PATH Act in 2015. So if you have less than 5 million in gross receipts for the current year and no more than, and looking back 5 years from the year in which you're filing the form, there are no gross receipts, which I know is a bit of a mouthful, but basically you have 0 gross receipts looking back to the 5th prior year, then you're able to monetize the federal R&D tax credit against payroll tax offset. So again, another powerful tool, but that section was slightly updated, adding additional checkboxes like, hey, is your payroll tax reported on a different EIN? So if you have like a PEO or a separate payroll company, you would want to make sure that that box is checked too. And then to Vivian's point on Section E, there was the update on officers. Right now, again, still optional for going through 2025, but you have to list out your number of business components, right? So you don't necessarily at this point have to say, these are all my business components, but you do want to make sure that you can quantify the number of business components that you have and make sure that those are defined correctly in terms of the product, process, all of those. So I know we covered a lot here and maybe skipped over a few of the updates here, just managing time. But Vivian, anything else you wanted to touch on for the new 6765?
No, I mean, maybe question number 38 and 39. So 39 and 40. Basically, they're asking for, did you acquire or dispose of a major trade or business in the tax year, or do you have any new categories of expenses as current year QRE? These are all questions there because the R&D tax credit is the credit for increasing research. So it asks for year-over-year consistency adjustments. So basically what this is asking is, if you acquired a new business, you need to be adjusting your base accordingly, if there's any adjustments that are needed. So again, it's important if you have gone through a transaction to make sure that you're doing your base period adjustments correctly, and give us a call if that's the case. We'd be happy to kind of take a look and make sure. I think polling question number 3. So does your current R&D process collect the information necessary to fill out the new Form 6765? Yes, no, I'm not sure. I'm hoping for a lot of yeses, but I'm also hoping for a lot of no's so that you guys can give us a call and that we can help you out. I do want to say that for folks who are maybe preparing their own R&D study, this is the year to give us a call, so that you can shore up and just have somebody who does this on a day-to-day basis for, a number of years now, to take a look at it and that make sure it passes muster. I think that's the most important thing. It's always important to get the process right sooner rather than later. Awesome. Okay, and then state R&D credit updates.
All right, so as everyone can see here, there are a lot of states on this grid, right? And the list continues to grow. So in addition to there being a federal R&D tax credit that companies can take advantage of, there's also over 35 states with their own credit calculation that you can take advantage of. Every state is different. Some have similar mechanics to that of the federal credit. So there's the alternative simplified or a modified mechanic there, or some kind of regular credit that looks at gross receipts, or as well as the current year research expenses. I mean, out of everything on this list, I will say one of my favorites is Arkansas, because not a lot of people know about it. They wouldn't expect that state to have such a lucrative credit. I think it has the highest credit rate out of any state credit out there. So 20% of any in-house research expenses, or in certain cases 33%, just a flat percentage of what you're spending in the current year. But Vivian, out of this list really quick, what is one of your favorites, or what jumps out to you?
Oh, I'm biased for sure. Just because my husband's from Georgia, I would want to say that award goes to Georgia. They give a lot of obviously tax incentives, right? Basically every film nowadays filmed in Georgia. But on their R&D credit front, they offer for all taxpayers who can't use their Georgia R&D credit against their Georgia income tax to be able to utilize it against their Georgia payroll withholding tax. So I think that's a great way for all taxpayers, not just qualified small businesses, to be able to monetize that credit immediately. So get your cash back into your pocket sooner rather than later. And I think similar reasons, I want to say Virginia, I love because they doubled their minor R&D credit pool, I want to say maybe 2 years ago. And we really saw how much small businesses benefited from that refundable credit. And it's always so exciting to get a refund check from the government. I always think it's a win. So those are my favorite.
Well, I don't know if that was a planned segue for our next slide, but like I said, there's a
Oh,
lot
right.
going
It
on at the
definitely
state
was.
levels. But just to highlight a few here for the group, right? Even if we're talking about a calendar year 2024 taxpayer, there are some next steps that we wanted to highlight to the group, just in terms of, hey, you have filed your state return. There's still a bit more to do. And again, to Vivian's point, there's a lot of great things about the Virginia R&D tax credit. One of the things I very much dislike.
Thank you, Eunice. Well, I'll fill in for Brian. So on Virginia, one thing that I did not mention is that administratively to be able to benefit from the credit, you would have to amend your Virginia return, because the way that it works is your Virginia R&D credit application is due September 1st of your tax year. Then you have to file your Virginia state return because that's then due. But that approval letter from your application doesn't get mailed out or doesn't get faxed out until I want to say like late November or early December. So by then, you would have to have filed your Virginia tax returns without the R&D tax credit. It would be a simple amendment, but you amend and then you would get that refund. So that's kind of how it works mechanically. For Georgia, in terms of the filing next steps, you, in order to file your Georgia R&D tax credit and make that election to utilize your Georgia R&D income tax credit against your Georgia payroll withholding tax credit, that is when you need to file your ITWH election within 30 days of filing your Georgia tax return. So if your Georgia tax return is due 10/15, you have 30 days from 10/15, so effectively 11/14, to make that ITWH election. The ITWH election is made through the Georgia Tax Center online, so make sure you do that within 30 days. Once that 30-day window is closed, you're basically out of luck, and it's not like you don't get to use your credit. Your income tax credit just stays an income tax credit and it gets carried forward. So unfortunately, you can't monetize it. And as we wait for Brian to kind of come back online, unfortunately, he got booted off. So we're going to see if there's any way that he can come back in. Let me go through the audit trends a little bit as well. So with the government shutdown, unfortunately, and the IRS resources being laid off and all of those things, what we're seeing is that there's increased time to the extent that you're under audit. So that's something that we are seeing, unfortunately. And I think we have Brian back online.
Yeah, so again, we don't have enough time to highlight everything that's new in the world of R&D for 2025, but for Michigan, there is a new credit for 2025. This is tiered. Again, similar to Virginia, what we talked about earlier, but rather than it being based on qualifying research expenses, it's based on headcount of your company. So again, the big news here is that there is a new credit. The tentative claim applications must be filed by April 1st, 2026. So there is a deadline in advance. It is refundable. So if the amount of the credits exceed your liability in Michigan, a portion of the credit that exceeds that liability can be refunded. And then there's also kind of a university add-on, right? So if you are partnering with universities within Michigan, there's an increased credit that you can get for that activity. Another big one that hit our radar was Texas. So Texas, since 2013, has had its own R&D tax credit. But the big change here is that, one, the sales and use tax exemption. So it used to be that you could either choose the R&D tax credit for Texas or sales and use tax exemption on R&D equipment. The sales and use tax exemption is gone, but for the R&D credit, it is supercharged. So your credit rate went up to 8.7% roughly, so close to doubling what the previous amount was. In certain situations, again, similar to Michigan, the credit can be refundable. So for entities with no franchise tax due, which could also include new veteran-owned businesses, the credit is refundable. So again, some big news coming out of Texas, and one of the biggest ones is that the definition of qualified research expenses is now aligned with that on the federal side. So there was always a big back and forth with the state in terms of how qualified research expenses are defined. So rather than it being an evolving landscape, it was a snapshot in time. And again, our definitions evolved based on court cases that we're seeing and what's out in the field. So I think that was a big win for taxpayers in the state of Texas. A couple others to hit on here. Arizona. So Arizona, the credit has been available, but do want to make mention that there is a refundable credit available in Arizona. It is on a first come, first served basis. The pool is $5 million. So again, looking at 2024, that was exhausted by March. So that's one that, hey, if you have less than 150 employees in the state of Arizona, even if you're not taxable, if you want to get a shot at that refundable credit, we absolutely want to get started sooner rather than later, the beginning of 2026. And then in a similar vein, right, Florida also has an accelerated timeline for filing. So by March 20th, the credit has to be pre-approved and certified by the Florida Department of Economic Opportunity by, again, late March. So that's one to keep on your radar if you're operating in Florida, taxable, something to put on your radar sooner rather than later. New Jersey, again, just want to call this out. We had some unique run-ins this year where that, New Jersey has a very powerful credit on its own. But even if you're not taxable, there is actually an opportunity to sell your credit on the marketplace. If applications are sent in to the New Jersey Economic Development Association Technology Business Tax Center. So there is a June deadline associated with that. It's not dollar for dollar, but you can potentially sell your credits on the marketplace. So do want to put that out there. And then the last, and sorry for talking so quickly, but the last big piece would be Minnesota. So that hit our radar. Minnesota does have an R&D tax credit, but the big update for 2025 is that there is an opportunity to get a refundable credit. Again, it's not dollar for dollar. It is taking your credit amount unused times a refundability rate that was introduced. So now it's about 19% of whatever your credit is, but you are able to monetize that. So good news for taxpayers, but those are some of the quick hits here looking into next year.
Thank you, Brian. That was super helpful. And then on audit trends, we were just kind of talking about government shutdown. Unfortunately, there's significantly less IRS resources than there was in the beginning of the year. So a lot of things are delayed. I would say audits are taking longer than usual to close or to settle. What else are we seeing in the market? Refund claims are taking longer and longer to process. Increased use of fast track settlements, but what else are you seeing?
Yeah, and tying back to what's top of mind for the shutdown, not only is it, hey, there's funding volatility, which makes it more difficult to pursue audit cases. There's also resource limitations, right? A hiring shortage, being able to train their staff, retrain staff. So we are seeing case transfers, reprioritization. That's a continued major concern for both, taxpayers and practitioners out in the field as it relates to that first point on increased use of fast track settlement. That, like you said, right, the IRS is aggressively pushing for earlier dispute resolution to try to clear that appeals backlog. Unfortunately, that's in direct conflict with the first point in terms of limitation of resources, the shutdown. So again, just an overall procedural shift that, outside of the current shutdown that we're about 3 weeks into, it just strengthens the fast track settlement, the FTS process. Again, trying to make that a commitment as a more viable option by the service. So again, as a proactive strategy, make sure that if you're in a situation where this is being reviewed by the service, to evaluate FTS as an opportunity to try to resolve issues more quickly while the case is still at the audit level. And that also preserves your right to, traditional appeals if FTS is just unsuccessful. I know there's a lot to cover here. We have about 9 minutes left. I mean, any big points that you want to pick up on, Vivian?
No big points, just procedurally, what I've seen is also your IRS audit agent could just keep changing. So that's something that unfortunately is something that I'm currently seeing now. And then maybe we can conclude with our recent court cases, which I think unfortunately has all been so taxpayer unfriendly.
Yeah, I think here there's just one exception to that taxpayer unfriendly piece. And again, this ties in with an uptick in litigation that we're seeing. And that's going to be, it's not even an R&D tax credit case. It's that first one on the left, Loper Bright Enterprises, where, this was a landmark Supreme Court decision that, even if it wasn't a tax case, it does have major implications for the R&D tax credit. So this essentially overturned the Chevron doctrine, which previously required, the courts to defer to federal agencies like the IRS for reasonable interpretations of ambiguous laws. And, really what we're seeing is, this shift gives taxpayers a better chance to challenge restrictive IRS interpretations of R&D tax credit rules in court. So I think over the last few years, it's been 95% unfavorable for taxpayers just in terms of the court's findings. But, this is one that does have a potential silver lining. There still is a lot on the slide that we have here, but I'd say some of the key themes that we've seen in the last couple of years, they tie in with the enhanced disclosure requirements for the 6765 and just the burden on taxpayers to ensure that there is contemporaneous documentation for the development activities that are occurring, both on projects and at the individual resources that are involved, as well as a particular focus on funded research. So just because you are paid by a customer to perform work doesn't preclude you from claiming those expenses as qualified research. So, as part of any R&D study, if you are working with outside parties, I mean, like a SaaS-based model for software development might be outside of that, right? If it's just sale, lease, or license, you're in a much better shape. But if you are providing services under a contract, it's imperative to evaluate, one, do you have substantial rights to the research? And two, is there significant economic risk in terms of the work that you're doing? So on that idea of funding, right? Mayor Borgman and Johnson, that was a piece that came up. This was a structural engineering firm that was hired to create structural design for building projects. And once the team looked under the hood at the contracts, payment was not contingent upon success of the research. So the contracts as they were built up, just based on acceptance criteria, warranty criteria, it was limited in that, it was just being built to specifications. So again, as you're going through and if you have contracts for providing services, we want to ensure that there is acceptance criteria associated with technical specifications or tolerances in order to receive payment, and that the research must be successful. So again, is payment contingent upon success? And that came up for Mayor Grigsby, again, saw it for a few others. And then the other piece and that key theme would be for substantiation of qualified services. So one that jumps out to me on this list and that we talked about a bit previously in terms of documentation for executives or officers was more, right? So the focus here was on contemporaneous technical documentation. This was for a manufacturer of scoreboards and related gear for different athletic events. And ultimately, the chief operating officer was being claimed as a eligible employee performing qualifying research, but there was a lack of documentation to substantiate the time spent by that individual on development. And even, going through and asking for, an estimate of the time, the COO was unable to provide an approximate estimate there. So again, it's just, if there is qualifying activity, we want to ensure that there is documentation to help back that up and that we are fully exploring the definitions of what is a qualifying activity. Is it direct support? Is it direct supervision or direct performance of development activities? So again, a lot going on here on the screen. Vivian, anything else to call out here that's jumping out at you?
Yeah, no, I want to say though that the IRS, when they go through litigation, I feel like they attack funded research more than they attack whether or not you're performing qualified research. And that's because it's easier for them to just argue the contracts, argue within the four corners of the contracts to say this is black and white, whether or not you have rights and risks versus qualified research activities. That's more of a grayer area, and I want to say is more taxpayer friendly because of how broad the definitions are. But funded research, if you are in process of negotiating a contract to perform R&D with somebody, this is the time to bring us in so that we can look at the contract before it's executed, to make sure that without going into the economics of the contracts, that it is still favorable for you in the R&D credit world. So to the extent that you're negotiating an R&D contract to perform R&D on behalf of somebody, or if you're paying somebody to do R&D on behalf of you and you want to make sure that you can claim the credit for that work, it's important to kind of call us now to make sure that we can look at it before you guys execute that contract. And it's also important to not just think of tax at the end of something, right? So involve tax as much as you can. Not to say that tax should be leading your business decisions, but I think contemplating what the tax impact would be is always an important business decision overall. With that said, Brian, is there anything else or are there any questions? Unfortunately, I can't quite check.
Let me see, and want to thank everyone for bearing with us on the technical issue, and hopefully us jumping around has livened things up a bit. But no, I'm looking and I don't see any currently on the chat, so I
Perfect.
think we're in good shape.
Awesome. Well, that brings us to that brings us to our last polling question. Make sure you get your CPE. Let's answer this. Would you like a team member to reach out to you? We'd be happy to keep you on the radar if you are contemplating new R&D contracts in the future, or if you are trying to tax plan and figure out, hey, is it better for me to take my 174 write-off in a single year or over 2 years? Or if you are considering amending your R&D tax returns or just wanting a second set of eyes on your current R&D study processes, we would be more than happy to reach out to you and kind of consult you, help answer any questions that you may have. I'm gonna keep this up a little bit longer so that we can get all the questions, all the CPE questions answered. Perfect. And then with that, that brings us to the end of today's webinar. Thank you so much for spending this time with us. If you have any questions or would like to keep the conversation going, feel free to reach out to us at any time. You have our contact information up there. And before you head out, we'd appreciate your feedback. Our quick survey will pop up automatically when you exit the session, and we'll be sending you the session recording and presentation in about a week, so keep an eye out for that. Thank you again for joining us, and we look forward to seeing you at a future webinar. Thank you all.